On today's hot sheet, I'm discussing new home sales, Realtor.com's rental report for December 23, and today's PCE inflation report. Today is Friday, January 26, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into the hot sheet. Love to know which market you're tuning in live from in the live chat. I am back in my Naples, Florida studio and pleased to be with you here on this free format Friday. This is going to be a fast-paced free format Friday. So if you don't jump in live now, you might even miss it. I've got to run into a Knowledge Brokers podcast recording right after this. That'll be up over on Knowledge Brokers podcast channel at 2 p.m. Eastern. You don't want to miss that either. And of course, to get the most out of what we do here at BAM, make sure you subscribe to BAMX. You can use code HOT to get 10% off of your annual on BAMX. All right, let's take a look at new home sales. New home sales continue to drive inventory in a significant way as inventory is depressed in most parts of the country. New home sales, new homes sold for December of 2023, as reported yesterday by the U.S. Census Bureau and U.S. Department of Housing and Urban Development, jointly announcing yesterday that 664,000 homes were sold, new construction homes, new build homes in December of 2023. This is an 8% increase above the revised rate of 615,000 in November. It's 4.4% above the December 2022 estimate of 636,000. So by all measurements, new construction, new homes in December were up year over year, month over month. And you had new houses for sale inventory seasonally adjusted at 453,000. So sold 664, again, seasonally adjusted. For sale, 453,000, seasonally adjusted as well. Median sale price for new construction homes down from the peak, but at 413,200. You can see houses sold bumping up there in November on the right, but still under the peak for last year and even the last few years, of course. An estimated 668,000 new homes were sold in 2023. It's 4.2% above the 2022 figure of 641,000. Now, the 453,000 season adjusted new houses for sale at the end of December represents supply of 8.2 months at the current sales rate. Okay, so 8.2 months of supply is, of course, would be considered a buyer's market. Anything above 6 months of supply would be considered a buyer's market. We certainly don't have that in total inventory in really any market in America, or in certainly not in existing home sales. But when you look at new home supply, which doesn't exist in every market, so some markets maybe more than others, you think maybe this has contributed to an Austin and other markets who have seen downtick. You're seeing 8.2 months supply nationally on new build, and at a 413,000 plus median sales price, these are at a higher price point, obviously, than existing homes, maybe contributing to some of that inventory sitting a bit. 8.2 months is more of a buyer's market. It's why you see lender buy downs. It's why you see incentives, or I'm sorry, not lender buy downs, but builder buy downs. You see incentives coming from builders to move some of this inventory. It's also why some of the projections are that housing starts will be flat or even down moving forward into this year because of that inventory that we do have on new construction. Here's the number here on sold. We had that big bounce up there in 2020 on single family houses sold in the U.S., coming right out of COVID, and has since come down here to about the 650,000, 664,000 for last year, but really bouncing between 650 and even 700 at times last year. As the rates hit, we dipped below 600 as the rates started to increase. As the Fed started increasing the rate, we saw that dip below 600. If you look at 2009 to 2015, we really didn't even crack 500,000 for that extended period of time before gradually starting to increase heading into 2019. That's your report on new single family houses sold in the US. You can get more information and original source links, of course, in our show notes, which we upload every single day for our BAMX members. Grab show notes for every segment that we do here on the Hot Sheet every single day inside of BAMX. Use it for your content, your communication with your database. All right, another big report that I'm keeping my eye on closely is what's happening with rents. We know that if you've been following the Hot Sheet, we know that rents are decelerating. Really, Zillow's the only outlier that believes rents are accelerating. Everybody else has rents going down. Everybody besides maybe Zillow and the Fed, because the Fed likes to look at owner's equivalent rent, which is basically looking in your mirror about 12 months. It's lagging data. Let's see what Realtor.com has to say if they support that that rents are coming down, or at least the appreciation has basically stopped. The U.S. median rent saw a year-over-year decline for the 8th consecutive month in December 2023, reports Realtor.com, down by 0.4% for 0 to 2 bedroom properties across the top 50 metros that RDC covers. The median asking rent was $1,713, $63 less than the peak of July 22. That's a negative 3.5% drop off of the peak. The rental market has experienced this significant shift in momentum in 2023 due to an influx of record high new multifamily homes. It's something that we've been calling for a year. This influx of new multifamily rental homes is going to lead to more inventory, lead to a higher increase in vacancies, and it has led to a downward pressure on these median asking rents. Though despite this decline, the rental market did not witness a new peak in rent prices in 2023. The anticipated weakness of 2024, according to RDC or Realtor.com, anticipates continued weakness in the rental market for this year, as the completion of more of this supply is expected to impact these dynamics and continue this downward trend. Okay, here's a chart from Realtor.com. Rents decline again, but nationwide rent is just 3.5% below that 2022 peak. You see the dark gray line, median year-over-year rent. This is that deceleration of rental prices instead of what it was doing, in 2021, where it went up 16%. It is in a deceleration, even going down there below 0%. Doesn't mean that the median rent, as you can see in the red line, has come down all of that much. It's below peak, but still, holding firm, just not continuing to go up. Another case that we are getting out of this inflation crisis here. We're going to talk about inflation here in just a second. There's some really intriguing data today just released on our fight against inflation. Here's November rents declined modestly, less than 1% nationwide for all units. But you don't see these, and this is now we're getting into this new year and this spring market, and we'll see what happens in the spring if these pop up. But if they continue to stay flat, that is good sign for the fight against inflation and how the Fed is going to track this. Here's some of the 50 largest metropolitan areas as it relates to rent prices. Atlanta year over year down 3.9%. Austin down 5.4%. Median rent in Austin is $1,500, but just over $1,500. That's for 0 to 2 bedrooms. These are all for 0 to 2 bedrooms. Baltimore $1,800, had a 1% increase. Boston had a 6.3% increase, almost $3,000 to rent a 0 to 2 bedroom in Boston, becoming a really unaffordable market for most. Charlotte down 2.8%, $1,500 there. You've got Cleveland 4.7% increase, but $1,200, much more affordable for most. Dallas down 4.7%, $1,500 there. Hartford, not applicable. Hartford, wow, sorry, Hartford. Detroit is applicable, 0.3% increase, $1,300. You've got Indianapolis, been a huge market for investors looking for single family. You got 2.8% increase and almost $1,300 in Indianapolis. Miami down 3.5%, still near $2,400. New York's up 6.2%, 2,800. So New York now under Boston, $2,800 in New York. Boston was what? What did I say? Almost 3,000, 2,950. Phoenix down 2.7%, 1,500 on the monthly there. You got San Diego at 2,800, San Francisco at 2,800, Boston now. I'm sorry, San Jose now. Looks like the leader out of these markets. San Jose almost $3,200. They had a 1.8% increase this last year. If you need more rental data, that'll be linked for everybody, easy to find with all of the charts and data inside of BAMX. All right, let's go into the PCE inflation report. Now, PCE inflation, I'll give you the headline straight out of CNBC here. PCE inflation gauge, which did rise 0.2% in December and was up 2.9% from a year ago. I'll explain why that is not a bad thing. I'll break those numbers down here in just a second. What's more important is PCE inflation, the core personal consumption expenditure price index, which was released at 8:30 a.m. this morning, is the Fed's favorite inflation gauge. Okay. This is the Fed's favorite inflation gauge. Okay. So why do I think these numbers you see rise on the headline are actually good for our fight against inflation? Well, number one, you've got a 0.2% increase in the PCE price index in December. Okay. The increase when excluding food and energy was still at 0.2%. That met expectations. Okay. Now, that annual number that you just saw here, it was up 2.9% from a year ago. That was expected to come in at 3. We're now under 3 for the first time. Okay. And remember, their target here is 2%. The Fed's target is 2%. We're now at 2.9%. And if you look at, here's the really good news. If you look at the last 3 months of the year, okay, annualized core PC inflation was running below 2% in the fourth quarter of last year. So I'll go to the Wall Street Journal here. Okay. Forecasters by the Wall Street Journal estimated the 0.2% that we talked about. It's up 0.1%. I'm sorry, 0.2 is up 1.1 from November. It's consistent with subdued inflation, meaning inflation continuing to go down. Okay. From a year earlier, economists estimate core prices cooled to a 3% increase in December from 3.2% rise the previous month. Now, the final 3 months of the year, overall inflation measured by Federal Reserve's preferred PCE index eased to 1.7% annualized rate, 0.3% below the 2 of the target. The pace is below the Fed's 2% inflation target. Okay, so that's really positive news here for what the Fed might do, maybe even an early spring cut on the federal interest rate. There are some expectations that support that. Okay, core prices past year, down. All prices past year, down. Core prices past 6 months, down. All prices past 6 months, down. All measurements of inflation right now are pointing towards a downward trend. This being their favorite reading here. Last year, it was at 5.4% in December of 2022. Now just under 3%. The Feds expect the annual advance will tick down to 2.4% by the end of this year, which is pretty close, even closer to that central bank's target. Okay, 2.9. We're zeroing in on that. I mean, so you're basically saying a half a point here for the rest of the year. Could we get there and more? I don't know. That remains to be seen. We've got a lot of data between now and then. We'll continue to monitor, see what happens. Personal consumption expenditure price index. This is the change from a year earlier. Okay, when we were up at 5%, now down on core prices, down to that 2.9% number. Okay, So there you go on inflation. Any other data on that? You will see. We'll take a look at the 10-year here in just a second. 10-year basically staying steady is the headline. We'll take a look at where it is up to the minute after another encouraging inflation report. Again, encouraging. This is a good sign, and investors are obviously going to continue to monitor this, as we will, because it'll impact the 10-year, or I'm sorry, the 10-year is going to impact this 30-year. If you look also, just a quick nugget here from Nick T from Wall Street Journal. If you look at 6-month annualized, they've got year over year 2.9, 6-month annualized at 1.9. The article in the journal said 3-month annualized at 1.7. He's showing 1.5. All of this are equal to or below the Fed's 2% target. So all good news there. Let's take a look at where we are at this moment here, 9:45 a.m. on Friday. 10 years actually up a tick, 4.150. So highest in the 1-day range, but not shooting up, also not shooting down. So there you go. I heard somebody on CNBC this morning, one of the analysts, saying they just don't expect much of a movement on the 10-year throughout this year, which would mean we need that spread to continue to normalize to get the 30-year fixed really down to where we want it, which would be sub 6%. We're at 6.9 as of yesterday's reading, off of the high from the week of the day before at 6.95. The Freddie Mac 30-year fixed weekly came in a little bit higher than the week prior at 6.69. That's your update here on the hot sheet. Hope everybody has had a great week. Hope that you'll consider jumping over to @Knowledge Brokers Podcast YouTube channel, different channel, @Knowledge Brokers Podcast, hitting subscribe, and I will see you over there for 2:00 for our newest podcast of the week. Have a great weekend, everybody. We'll see you back here Monday, 9:30 on the East, 6:30 on the West. And until then, toodaloo.